at least 4 interest rate hikes, that this possibility is priced in the equity markets too, increasingly. And if anything, oil prices going up are an incredibly burdensome tax on the lowest socioeconomic demographic sectors in our economy. So I think the fears here are going to shift from rising interest rates and higher inflation, potentially to recession, especially, and you've heard me on this before, because we see inventories piling up throughout the ecosystem. So innovation stocks in the public equity markets are down, I'm going to say broadly, 50 to 75% in the last year. I mean, that's as bad as it got during 08-09. Now, in the private markets, of course, we're seeing one example after another where the pricing is up in the last year. What's going on? The move to risk off for many traditional asset managers means get back to your benchmarks. And if you look at the broad-based benchmarks, even the broad-based tech benchmarks or tech-oriented benchmarks, you're going to see that they are short innovation, true innovation. They're mostly in that the innovation that they're capturing is mostly in the mega cap tech stocks. They've become a disproportionate weight in many indices, and I would submit in many assets, portfolios in the traditional asset management world. This move to benchmark style investing, we believe has been turbocharged during the last 20 years by the tech and telecom bust first, and then the 08-09 meltdown. And the risk aversion in the markets is palpable. And so going back to benchmarks or repositioning portfolios so that they are closer to their benchmarks seems to be what has been going on. What happens then? Well, they're selling the real innovation stocks out there. And so the way we've set up our research, ARK is benchmark agnostic and long-term in its time horizon. Our investment time horizon is 5 years. And therefore, our analyst responsibilities are set up in a way to encourage the collaboration and explore the convergences between and among these technologies. Their responsibilities are set up by technology, very, very different from the traditional asset management world, because we believe each of these technologies is going to cut across economic sectors. So they are specialists and they are domain experts in these technologies, and they're generalists when it comes to sectors, because these technologies are going to fall in price, and therefore access will open up to many more sectors, in many ways going mass market. So I'd like to talk a little bit besides that about the differentiation. We have, as I mentioned before, Brett Winton, our Director of Research, MIT engineer, educator, an entrepreneur, and a financial analyst for years. We have our analysts, the domain experts. The collaboration that you see is visible, and it was today on this seminar, when you listen to William talk about artificial intelligence, and then you hear is to understand how quickly the costs are going to fall, and what will be the price elasticity of demand. So innovation solves problems. And you heard about a lot of the breakthroughs that are going to solve problems. We saw it last year with COVID. In the last 2 years, COVID, innovation solved problems. We had tests and vaccines that no one dreamed we would have in the short time period that we got them. And it was all because of innovation. Now we have supply chain issues, we have labor shortages, we have the cost of capital going up, and we have automation of all kinds, and we have DeFi. And so we really do believe that the innovation in that we are researching is a wonderful complement to the traditional asset management oriented portfolios, the traditional growth and value portfolios that are benchmark sensitive. Because if we're right, there is going to be a lot of creative destruction in the traditional world order that is represented by the more traditional. I guess I'll close by this section by saying, inflation and interest rate risks seem to be priced in when you've had this kind of a correction, and the broader market has joined in as well. We do believe that innovation is on sale, and we do believe that it will be really important for investors to move toward the right side of change, given the amount of disruption that we do expect, and that I hope our research today telegraphed to you. It's also very important to keep that 5-year investment time horizon. The difference between linear growth and exponential growth when you're talking about a 5-year period is enormous. And because Wright's Law gets us to, I think, to the right answer in terms of the exponential growth trajectories, the surprises are going to be enormous. And most important, we like to say, as we're focusing on the 5 years, keep your eye on the prize. We realize it's been a very difficult market. We also do believe, and our conviction this past year actually has increased, that these exponential growth trajectories have been accelerated by COVID, and even more so now by the turmoil we're seeing in the labor markets, logistics, and in the financial markets.